You just got a credit card offer in the mail, 0% interest rates for 18 months. That sounds like a great deal. But what if I told you that you're not a customer? You're actually a product. That piece of mail is not just an act of kindness from the credit card company. It's a carefully calculated move in a multi-billion-dollar gamble, and the credit card company is betting that eventually you're going to. In this video, we're going to pull back on the curtain and we're going to show you how the hidden strategies that you decide why and when you get these offers, and how the bank sees you not as a person, but as a risk profile, and how they use the entire economy as a signal for when to dangle that 0% carrot in front of you. Let's get one thing clear. To a credit card company, you're not a customer. You're an asset. You're the number in the massive, complex portfolio that is built for one and only one thing: maximizing the profit for them. This portfolio is their entire business. Every decision they make, from interest rate they offer to the color of the card that you get, it's all about squeezing as much money as possible from that particular portfolio from customers like you. So why would a business that makes money from interest ever offer you a 0%? I'm curious. It seems completely backward. But because these offers are not randomized, they are very surgical, data-driven decisions. The arrival of a low-interest credit card in your mailbox is actually a signal. It's a signal about the health of the economy, the bank's appetite for risk, and more importantly, it's a signal of what kind of customer they're betting that you will become for them. The entire credit card business model is built on splitting their customers into basically two groups. Understanding the split is the key to understanding everything that revolves around the credit card business. There are two types of customers. Let's talk about that. In the credit card world, you are either a transactor or a revolver. This is the insider lingo that the banks typically are going to use when they refer you as a customer. And you need to know which one you are, so it's going to benefit you. A transactor is someone who uses the credit card but pays their full entire balance every single month. They never have any credit card debt, so they never paid a penny in interest rate. Now the bank, they do still make money from the transactor through the interchange fees. This is the small percentage fees that the merchant actually pays to the bank every time you swipe your credit card. Transactors are steady and reliable, but they're very low margin to the banks. Then there are revolvers. A revolver is anyone who carries a balance for 1 month to the next month. They revolve their debt, and for the credit card companies, these guys are goldmine and jackpot. The profit from a single revolving paying customer at 23% interest rate can be more than profit of hundreds of these transactors. For a major bank, interest income makes up majority of their profit. When you add a late fees, the number gets even spicier for them, and it gets even bigger. So the whole game is to build a balanced portfolio. They need transactors for volume, for interchange fees, but they also need a predictable number of revolvers to be wildly profitable and wildly successful. And this is exactly where those 0% teasers rates come in. The 0% interest rate offer, let's talk about that. It's a bait. Specifically, it's a customer acquisition tool for the bank. It is one of the most expensive marketing costs for the bank, and they don't take it lightly. There are many ways calculated before they actually place this type of offer. So before the mail gets out to millions of those offers of customers, the risk analysts have already built a model that predicts with unnerving accuracy what percentage of the people who are going to accept this offer are going to fail before the promotional period actually expires. They're betting that a slice of those disciplined transactors will eventually convert into long-term interest-paying revolvers. They know life happens. An unexpected expense comes up, so you lose the track of your deadline, or you just get comfortable making those small monthly payments every single month. Those moments that promo period ends, the interest rate can skyrocket, sometimes even larger than 20-25% or more, and the profit machine roars to life for these banks. Think about the math for a moment. They might lose money on you for 18 months of that 0% interest offer, but if your trial period ends with a $5,000 balance and the rates jumps to 23%, you're suddenly paying nearly $100 a month in interest alone. Your minimum payment will barely touch the principal. You're now a profitable revolver, and the bank's gamble has paid off. They're willing to lose 99% of the people who pay off their balance just to capture that one person who does not. Their model tells them exactly how many people will it be. It's a game of averages, and the house almost win in this case. So we get the strategy, we understand the dynamics, and we understand the bait the bank is using. But what about the timing? Why do these offers flood in your mailbox in some years and they completely disappear in other years? Have you noticed that? Because it's a direct reaction to the wider economic condition and how much risk the banks are willing to stomach during that economy. During the good economic times, when the unemployment number is low and the confidence is high, the credit card companies get aggressive. Delinquency rates are down and people are paying their bills on time, and the existing revolvers are a reliable cash cow. In this type of environment, their appetite for risk actually grows, so they take more risk. The smart spending they spend a lot of money on the customer acquisition. They push out these generous 0% APR offers. They also lose their underwriting standards, making it easier for customers to get approved. Basically, what they're doing is they're planting seeds and acquiring as many customers as possible, knowing that a small percentage of these customers are going to become a profitable revolver down the line. But when the economy gets tough and things look shaky, the strategy is going to flip almost overnight, which is basically happening right now with the tighter economic condition. As the unemployment rate ticks up, you hear a lot of talks about recession. They slam their brakes. Their focus now shifts from acquisition to damage control. The underwriting standards, they become tighter, making it much harder for anyone to get a card. In fact, the 0% offers, they start to dry up. At this point of time, their priority is managing the risk that they already have, worrying about the current revolver when they're going to start defaulting. The last thing they want is to take new unproven customer with a teaser offer like a 0%. And then there's also the political wild card. Early 2026 this year, President Trump called the Congress to pass a legislation for a temporary 1-year cap on credit card interest rate at 10%, which is really good for the consumers. This is a massive threat, although, for the industry and the bank's business model, where average rates can be double or triple than that number. In response to that, banking giants like Bank of America, Citigroup, they have already begun considering offering new credit cards with rates as low as 10%. This move is not out of kindness or they love you. It is basically a strategic olive branch to preempt a mandatory nationwide cap that could actually devastate their profits. It's a high-stake chess match, and it shows how low interest offers are used, not only just an economic tool, but as a tactical move against a political threat. So let's talk about how do you win the game. Now that you have seen the playbook, how do you actually flip this to your advantage? Because that's what this channel is for, and that's why I'm here to help you with that. How do you stop from being a pawn and make their strategy work for you? Well, first, when you see a 0% offer, understand that it is a tool. It is a fantastic opportunity for you to pay down a high interest debt with a balance transfer or a financing a large purchase without paying interest rate. But you must be disciplined. The bank is betting that you're going to fail. Beat them at their game. Make a concrete plan to pay off the entire balance before the promotional period ends. Divide the total number of months and make your non-negotiable monthly payments every single time. Set the calendar alert, set your SMS or email alerts before the 0% offer is going to expire. Second, you need to know the profile. Are you a disciplined transactor who always pays the bill in full every single time in that month? Then you're in charge, you're in control. But you can sign up for the best bonuses and rewards and whatever paying terms, it does not matter to you because you're not going to pay any interest rate. If you already know that you're prone to being a revolver, you like to carry that debt, be extremely cautious. The temporary 0% relief can easily become a trap that leads to even bigger debt problem that you may have in the future. Finally, watch the economic cycle, watch the economic condition. When the economy is strong and the offers are going to be plentiful, that's the time you actually shop for a new credit card or refinance a debt. When you see those offers start to disappear and the standards for underwriting starts to tighten, take that as a warning sign about the economy and focus on reinforcing your own finances versus trying to accrue new debt. The next time a low interest credit card offer comes to your door, you have to see it what it is. It's not a mail. It's actually a calculated move based on a portfolio strategy that sees you as a risk profile. You are an informed player, and in the world of personal finance, that knowledge is going to be the ultimate power move. To learn more about how do you play the game better than the businesses, watch the next video on the screen to become expert at using credit card.